Let's get more here with David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital Management. He's on Zoom from Naples, Florida. So that's not too shabby.
Nice.
Yeah, nice job on that one. David, 40,000 for the Dow. It's a nice round number. We like nice round numbers. You buying it?
Yeah, I'm buying it. Good morning, Alex and Paul. The market just has a lot of things going for it right now. There are things that were tailwinds or were headwinds have become tailwinds. We've got strong earnings. We've got a Fed that I think Jay Powell's looking for a reason to cut. And I think the Janet Yellen wants Jay Powell to cut so that she can afford the service the debt, our national debt, better. And we look forward at market fundamentals. We look forward at what's happening with generative AI and what that means in terms of what we're calling the next industrial revolution. This deal with Apple and OpenAI and the power that people are going to have in the holding their hand in a handheld device. There's some things that can trip us up, but the market's really in good shape right now. And market sentiment has changed so much. Investor sentiment from just 2 weeks ago, it's incredible.
So, David, talks about earnings. What are your takeaways here for this earnings, which have generally been pretty solid across the board? What are your takeaways?
Well, we went through the earnings trough, and we've emerged from that. And now, when we look at first quarter earnings, we're coming in well ahead of expectations. Profit margins are the best in 2 years, and that's really the key. When there's so many questions about the Fed. Look, we've been, just since the beginning of the year, we've been all over the map on how many Fed rate cuts we'll get this year, anywhere between 0 and 7 or even a rate hike. But when we look over at fundamentals, just corporate earnings are coming in better than expected. And, that's obviously positive for stocks and one of the most important long-term factors. And we're looking for double-digit growth in earnings down the road this year. So it's a scenario that if we continue with some multiple expansion, earnings continue to do well. The Fed, if anything, that is looking to show that they're on a cutting cycle. They want to cut at least once to show they're on a cutting cycle. It's just they're having trouble. They got help with non-farm payrolls. They got help with retail sales. CPI, we're going to see an opening here, and that'll just be more, another catalyst, more horsepower for the bulls out there to take the market higher.
So does that mean
coming with? I'm sorry, I was going to say with it coming on more in the spirit of a normalization of Fed policy, not because the recessionary forces out there are becoming overwhelming and we're seeing a slowing economy. We're not seeing that. GDP has remained quite strong.
So when you talk about the AI and the new industrial revolution, what's so interesting is that utilities over the last few weeks in May have been the second best performing sector in the S&P along with tech. Can utilities be a growth sector in this environment that you're outlining?
I think that's yet to be seen. The belief there, or the thesis there, is that there is going to be so much energy demand for all these super chips and all the energy required for this revolution, this implementation of generative AI. I think it's also investors looking for more areas they can diversify into, but I think it's yet to be seen how much that really translates. That demand for energy translates into actually pushing utility stocks higher. It's not a typical reaction function we've seen in the past, but we can see how it could be one going forward.
David, aside from the AI play, a lot of investors feel like maybe they've kind of, at least in the short term, missed some of the big Magnificent Seven plays. What are some other areas that you think there's maybe value out there in the marketplace?
Yeah, well, we've been saying this for a while, even when we've had these sell-offs in the Magnificent Seven or the Fabulous Four, or really just mega cap tech.
Yep.
to stay with them, because they're really becoming all-weather stocks with these fortress balance sheets and wide moats around them. And Their balance sheets. They companies like Apple. Microsoft doesn't matter what rates are doing. So it's such a good place to have a good portion of your portfolio in large caps, specifically large cap tech with that focus on AI. But yeah, we look to other areas that have done well, and it'll depend how the economy moves forward. There's still this risk we move into a stagflationary environment, which might lead us towards commodities. There's also, do we have a hard landing, soft landing, or no landing? We've been calling for the no landing scenario. I think we're somewhere between soft landing and no landing, but clearly in a Goldilocks economy. So a lot of different sectors are looking good.
Yeah.
And overseas, there are even some areas there that are attractive.
Well, where overseas? I know that the Nikkei in Japan has been a huge hotspot, particularly with the weaker yen.
Yeah, that's really our main play is Japan. A lot of it is in fact the currency play, and if you invest in Japan, do it with a currency hedged vehicle. But the rally in the Nikkei 225. I mean, we reached a high here this year that we haven't seen since 1989, when I was walking around the campus at Stanford learning how to invest and learning about business, right? I mean, it's been that long. And so there's, with corporate reforms, things that still are ringing true from Abenomics, Japan is in a position struggling with monetary policy, obviously, but with that weak currency, they're an exporting country. Their products are so competitive abroad. And so that's why they've done so well. You've just got to hedge that bet. Europe is starting to look a little bit better too, from where they were a year ago. The concern here is where rates go. When you come to emerging markets and some of the other more interest rate sensitive economies, like we've seen China, a resurgence in China recently, but we would continue to avoid there for now because of the structural problems they have. But it's really right now for us, it's America first. The U.S. economy is still rolling, in a pretty strong manner. The consumer is still strong. We're wondering, how many times have we heard the consumer's running out of money? The consumer's they're gonna run out of pandemic money. They're running out of money. They're borrowing, but the consumer's still strong, and that's the mainstay of our economy. So no pun intended. That's the mainstay of our economy. And we're America first with looking for some opportunities to tactically allocate to some other areas to manage portfolio risk.
All right, David. Always appreciate checking in with you. David Kudla, he's a founder, and he's the chief executive officer, and he's the chief investment strategist over at Mainstay Capital Management, based in Michigan, but smartly right now in Naples, Florida.